Well, thank you for joining us today. First thing I'm going to talk about is the clay shoot. Yes, it was last week. It was a fantastic time. Loved raising money for multiple sclerosis. Prize table was great. The course was great. The pig we roasted was great. If you didn't join us this year, make sure you mark your calendars again for next year. We're looking forward to the 14th coming up. If you have questions for future installments, go ahead and make sure you send them here. And with that, what's this week's question? What are we going to do if interest rates rise? And first, I want to start with a couple of things. Obviously, Alan Greenspan passed away here this last weekend, so he was a former Fed chair. He died at age 100. Incredibly important how we think about monetary policy. There's something called the Greenspan put. He was incredibly influential, and we're sorry to see him go. The other thing is with rising rates, I think a lot of people get the idea wrong that, well, we're going to talk about several things, but people talk about high rates and low rates. Low rates are good for the economy. High rates are bad for the economy. Let's just clarify that for a second. Part of it is also which direction you're going, right? So this is a chart of the Fed rates, and the Fed controls the short rates. They don't really control long rates. They control short rates. So the overnight rate banks lend money to each other at. In 1983, rates were rising, right? That hurt the bond market. And then 94, 95, 96, 97, 98, 99, rates sort of were in this tabletop effect. Great years in the market. And then rates fell. So we actually had high rates. We had very good economic growth. When we had low rates in 2001, 2002, not so good, right? So that sort of dispels this. It's part of this is also which direction you're going. The economy strengthened after 2003 into 2007. We were raising rates because the economy was strong. When did we drop rates to zero? When the economy was falling apart, right? So yes, high rates do slow down the economy, but it means the economy is usually strong enough to take it. If you have zero rates or low rates, it means the economy is very weak and needs the extra assistance. So the direction, there's really not just high and low, there's four quadrants. It's high and rising, high and falling. You have to think about it in that context. Right now, it looks like we're going to sort of be repeating that tabletop effect. And the question is, sort of at the end there, we raised rates into 1998, 1999, because the economy kept getting stronger. And right now, the economic growth numbers seem to be fantastic. The earnings growth numbers from S&P 500 companies are knocking the cover off the ball. And if you look closely at this chart, there's a couple of things you should notice, right? We had low rates for a long time. There was a little bit of a blip there when we were trying to fight inflation that ultimately didn't manifest. Now we're trying to fight off inflation, and the green line there is the market expectation for rates. The blue is what the Fed thinks they're going to do. And the purple there is where the Fed wants to get in the long run because they believe that to be the neutral rate. Now, this was Kevin Warsh's first meeting as Fed chair, and he ultimately didn't put out where he thought we should be on the plot. But half of the governors said we should raise, the other half said we should hold. When do you have room to lower? Well, when you have low and stable prices and you have a falling apart jobs market, you usually want to lower rates. Well, the jobs reports coming up seem pretty strong, so that's not a great excuse to lower rates at the moment. That's what people are thinking. If the jobs are strong, then we want to focus on inflation because of the Fed's dual mandate, low and stable prices and full employment. Those are sometimes competing goals, but right now it seems like they're both in the same line, is that you want to raise rates a little bit to tamp down inflation. We do have relatively high headline inflation compared to like a year ago. A lot of that's because of geopolitical risks and particularly energy and oil prices. Core inflation, which eliminates food and energy, has actually been relatively stable over that period. And shelter, the biggest contributor to core inflation, has been falling now pretty steadily for the last several years, right? Although housing prices are up, the rate of housing prices has decreased tremendously over the last few years. The green line tends to be more right. The market tends to know where the Fed's going to do more than the Fed announces what it can do itself. But this is the short end of the curve. So what happens here? People probably get more money on their money markets, especially if you have money to save. The opposite, if you have money that you don't have to save, it hurts because you're probably paying money on credit cards or loans, and those rates are probably going to go up. I think about myself or many of my clients. I don't know what my credit card interest rate is. Why? Because I never seem to pay it. I pay it off every month. Well, if you are paying it and you're accruing interest on a regular basis, then you are very focused on what those numbers are. And that probably hurts a little bit more if rates start to rise. But again, this is the short end of the curve, not the long end of the curve. So let's talk a little bit about that from an investment standpoint. This is where we started the year, where we are, and then where we're predicted to go. So this is numbers from just before the holiday. Light blue is where we started the year. That's a normal curve with a little bit of inversion, meaning you are actually paying a little bit more to borrow at a shorter rate than just, a year or 2 or 3. The dark blue is where we basically are today. We have a normal looking curve. It's exactly how you'd expect. If you want to borrow money for longer, you have to pay more. And the green is where the market is sort of betting and using hedges to figure out where we think we're going to be by the end of the year. You notice there's a little bit of rise across the board in almost every category. But particularly the biggest rise you're actually going to see is probably on the short end. That's what the market is currently predicting. So that's the biggest effect. The longest effect, the 10-year, which is how mortgages are based, that's how most people make long-term investment decisions, rises a little bit. And does that change some behavior? Of course it does. If you can get closer to 5% for essentially risk-free money, you're probably more likely to take it than trying to get 7 or 8 with a lot of risk involved. But ultimately, that is a major driver of those decisions. That takes several years to change behavior. The short end of the curve does not change behavior. There's no business owner that decides not to build a 30-year factory because interest rates have risen by a quarter point on the money market. That isn't what happens, right? It's really the 10-year that ends up driving some of those major investment decisions. And if you have a curve like this, what the bond market is saying to you, because they're always worried about economic growth, they're always worried about inflation, is they're saying they expect the market and the economic outlook to be very positive. For a long time, the yield curve was inverted, which means they expected negative returns in economic outlook. If you have a flat curve, you're expecting sort of stagnant growth. Now we have a steep yield curve, we're expecting accelerating growth. This is great news, but it's also about expectations. It's not necessarily exactly what happens, but this is the expectations of the bond market. So what do we do from an investment standpoint? How many raises do we get is very important. On the short end of the curve, it does make some difference for short-term borrowing, short-term loans, things like that nature, but it probably doesn't change massive overall investment decisions. The long end of the curve is still driven by markets. If anything, the short end of the curve probably makes the US dollar a little bit stronger, because if we pay more on our short dollars, well, if you're in Japan and you're getting paid 1.5, you're probably more likely to trade it for US dollars and try to get close to 4.5. Right? That makes sense. So people will have a higher demand for dollars. You see a strengthening dollar, which I think the dollar just hit a stronger level than it has in the past few years. That's part of that thought process. So with that, I'm going to conclude there. Thank you for joining me this week. The current recommendation is 1929, but our next upcoming recommendation is Why Nations Fail. We're obviously not going to see you next week because we got a short week with the 4th of July, and then hopefully we're coming back very shortly after that with our quarterly chart party. Thank you for everybody for joining me, and we'll see you soon.